so what we're going to do now is discuss the answers to activity 9. Right, so I have given you activity 9 for you to do. I hope that you've had a look at it and you've completed the general journal entries for the formation for start, middle, and end. I know it's very funny, but right, so let's start first of all with start. And this is the general journal entries. Now remember, when we form a partnership, okay, so here we've got start, start, we've got M middle, and we've got E end. So we've got 3 partners who've now decided to come together and join. Now, start already had a business, and middle already had a business. Now, E end did not. So now they're coming together, but when we account for the formation for the very first time, we have to journalize what they are individually contributing to the new business. So let's have a look at start. So this is what he brought in. Now remember, with a general journal, okay, you've got the date, okay, so the date would be the date that they are starting the new partnership. In the particulars column, okay, this is what they have contributed, right? The debit side, we know, debit side records all assets. The credit side records all liabilities and their owner's equity. So let's see what's this about. So for start, he brought in a bank, or rather cash, of $20,000. Right, his accounts receivable, okay, now look at it, it's $35,000. Okay, now the reason why it's $35,000 is because he will bring in the original value of all of their accounts receivable. So people that owed money to start. Then to reduce it, now in the question it said that for accounts receivable for start, the following revaluations will take place. So his accounts receivable will be valued at $29,000. Now, you do not change the 35 directly to 29. In order to make it 29, that is why we have the allowance for doubtful debts of $6,000. So if you take 35 minus the 6, that is $29,000. So if you have put in accounts receivable $29,000, that will be marked wrong, right? The way that we reduce accounts receivable is through the allowance for doubtful debts. So for example, again, just random, if they said, oh, start, your accounts receivable is revalued to $30,000. So accounts receivable will still remain as 35. To bring it down to 30, this allowance will be 5, because 35 minus 5 will be 30. Okay, so far? Next, he brings in the building. Now, originally, his building was $200,000. He had a less accumulated depreciation of 20. It was 180, but according to the revaluations, it says building becomes 195. So remember, we always take for PPE, property, plant, and equipment, we take the value that they are saying it will be revalued to. So not the 180 in the original balance sheet, but the new value of 195. Goodwill, this should have been calculated last. Okay, we always calculate goodwill last. Okay, so we know accounts payable, doubtful debts, where that has come in. And then it also says accounts payable remains as 15,000 and the mortgage remains at 95. Now, why is it that mortgage will not change? The reason being, correct if you're thinking, because it doesn't depend on the business. It depends on the bank, right? Just because you have formed a new business doesn't mean that the bank will say, okay, you can put what value you want on your mortgage, right? That's why for mortgage it remains as 95 because that's the value of it with the bank, 95,000. Some businesses will say to one partner, actually, that's your mortgage, we do not bring it to the business. So they will continue to do it themselves. Okay, then you've got S capital from S start. Okay, so his capital, right, comes in and it says, number 3, the agreed value of S start's business is 175,000, even though in the original balance sheet it was 120. Right? They've all come together and they've agreed that his business or what he's bringing in to the new partnership is worth 175. So you would have found that 41,020 plus 35 plus 195 minus 6 minus 15 minus 95 minus 175 would have given you that 41,000. That's why goodwill, you always calculate last. You just write it down and leave a blank. Add up all your assets minus your liabilities minus your proprietorship, it will give you 41,000. And then when you add 1, 2, 3, 4, it should equal 1, 2, 3, 4. Okay, so far? If you have any questions, please flick it through. Let's move on to the next partner. Okay, so M middle. Okay, so for M middle, he's saying, right, number 2, the following revaluations will take place for M middle. Accounts receivable will become 8,000, equipment 16, land 120, inventory 16. So M middle doesn't actually have any cash in bank. But if you look, he's got a bank on the credit side, which means that's a liability, which means it's a bank overdraft. So what are the assets that he is bringing in? His inventory will be 16, not 18 as per the original. It's 16. Then his accounts receivable, we always take the original, 10,000, but it's saying that it's valued at 8. So to make it 8, that's why doubtful debts here is 2,000. All right, 10 minus 2, 8. What else is he bringing? Equipment. All right, they've said the equipment is revalued to 16,000. Remember, this is the new values, the revalued values. Land, 120,000. Goodwill, but we leave it blank. We don't write that yet. We've got doubtful debts. He is bringing a bank overdraft of 3,500, accounts payable of 6,500, and a loan of 32,000. Right? And then, as per number 3, the agreed value for M middle's business is 125. Originally, it was 103,400, but we don't use that. We use 125,000. So 125 plus 32 plus 65 plus 35 plus 2 minus 16,000 minus 10,000 minus 16,000 minus 120,000 is the goodwill value. Okay, so that's for M middle. Any questions? Please write it down. And lastly, right? So lastly, we've got the last partner, which is End, and we can tell from his general journal entry that he actually is someone who's coming into business for the very first time. So as per this, E-end is to contribute sufficient capital to make his contribution 1/3 of the total capital of the partnership. Alright, so his contribution must be 1/3. Alright, so 1/3 of it, you can calculate, it comes to 150,000. So basically, we're going to debit bank. Some of us must have written cash. That is okay if you've written cash. So debit bank, credit capital, E-end, 150, 150. So this way, he gets 1/3 of the partnership, which means that start, middle, and end are all equal partners. That means they have 1/3 share each.